Ladies and gentlemen, our next speaker is Bharat Shah, Executive Director, ASK Group. He is a veteran of the stock market, often considered, often called the Bhishma Pitama of Indian markets. Welcome, Mr. Shah. Great to see you.
Thank you.
Great to have you with us. Thanks for taking the time out. And we believe that you're a veteran of the markets. You've seen so many episodes of bear and bull markets and volatility. I don't think that's something that you should have been surprised by. But the pandemic is a completely different issue. I mean, this is unlike any slowdown, unlike any depression or recession, whatever you want to call it, unlike any bear markets that you may have seen, because it's largely caused by a pandemic. I believe, sir, that you want to talk to us about some things on your mind, and you have a presentation to make to us. So I would request that you continue, make the presentation, and then we'll have some time for questions and clarifications.
Okay. I don't give any PPT, but I'll speak about a few points.
Sure.
Let me talk a bit on disease itself, though I have no telling points to make. I'm not an epidemiologist. A bit of comments about the state of markets emanating from that. Whether it is all dark and gloomy, or are there any silver linings out there, and what could be a potential approach to be taken. On the disease, I think it is very clear it is not severe or fatal, but it is contagious part, which is causing the social distancing and therefore unprecedented physical locking down of some 130 crore people, never in the history of civilization ever before. Therefore, economic impact is not coming actually really from any scare of a fatal or a terrible disease of that kind. Humanity has dealt with many pathogens, many diseases, far more vicious, far more with the mortality. It is the contagiousness and the physical distancing, and therefore physical shutdown, which is actually the key point. But why not going to disappear once the lockdown is lifted, and therefore we all will have to alter in some sense, at least for some length of time, the way we live, we utilize, and the way we work. All these will call for some of the changes. Whatever I can see, the impression I get is that after the initial shock, because this happened too suddenly, too quickly, and in the world of social media, everything seems to amplify in your ears and eyes way too much. And therefore, reactions will be from normal, extraordinary to bizarre in varying range of emotions. When the dust settles, when the little more sobriety dawns upon, when people take a little more longer-term perspective, then it will be realized that while it's a challenge, it is something we can deal with. It is something that we can live with. We live with many pathogens. Many of them are even more infectious. And we have overcome that. We can't stop living, or we can't stop our lives. And therefore, we'll have to have precautions. We'll have to have sensible safety measures. It's important to have even legitimate amount of fear. But I think it is illegitimate to have irrational fear or a paralytic kind of a fear, which in many, in the society's minds, I think it is kind of showing, and even in the markets. I think government has done a good job in dealing with the challenge has been early, strong measurements, so that we have dealt with well. This is a time now to build on from the virus will lurk around. Some more victims it will claim over a period of time. But science and technology evolved rapidly. the speed with which we have found virus isolation, its genome structure, and the speed with which medicine and vaccines are sought to be developed, I think there are more reasons to be reasonably be hopeful rather than be crippled by neurotic worries. Therefore, the impact on the markets, I think, has to be viewed with a sensible balance.
Sure.
Prices have not just fallen, they've fallen across the board, across all the sectors, even the ones which are benefiting, they too have witnessed a drop. And in many cases, prices have dropped rather way too much. And I would say that these price drops are not merely price drops compared to history of 9 weeks or 10 weeks back. These are actually drops from their underlying value. Therefore, there is a real margin of safety which has emerged. And I'm talking with respect to high quality businesses, high quality managements, strong balance sheets, not the weak and the waffling ones. Therefore, there is real margin of safety. Now, as investors, we know there are two sets of returns. One is a margin of safety. Inverse of that is a one-time return. And second is an annuity. Long-term earnings growth in future is a terrific proxy for a long-term investment returns. Margin of safety is a serious advantage which has emerged. Maybe current year's earnings will be dented somewhat, but in a, say, 10-year journey, 1 year we may have to forget and we'll earn 9 years of earnings. So there is a 9-year annuity to be earned in a 10-year period. And an important high margin of safety where prices have dropped anywhere from 15% to maybe 50, 60% from their value in 8 or 9 weeks' time. That's where I think the opportunity lies. But the cheap prices don't automatically mean that things can't get worse. Cheap prices are no guarantee that they can't fall anymore. They can. Therefore, all possibilities remain. Prices, because we can predict rationality of value, but we cannot predict irrationality of fear or sentiments. And therefore, prices in near term still can be seized by those fears. And therefore, three possibilities remain. Prices may fall further, even though they are cheap already. They may remain around for a length of time, seeking direction. And they may go up from here on, and we may have left this behind. I can't comment what will happen out of the three. But all I can say with confidence, when I put the economic equation of investing into the play, where margin of safety, the inverse of that is a real extra return, one-time one which has emerged, and significant one. 1 year earning, let me say, is dented in a long-term journey. So that doesn't change value that dramatically. Compared to that, the margin of safety is a real advantage. Finally, therefore, if we have a long-term view, we have capital, we have balance of the mind and serenity and tranquility of mind, knowing fully well that things may still go in a yo-yo mode for a while. There can be challenges, but if we longer-term view, we pick well, we remain with the quality franchises with proper equation of the economic margin of safety as well as the underlying earnings growth assessment. If the business models are not damaged or dented, then merely this episode is not good enough to change the price equation that much. And therefore, that's where I think the real opportunity lies. I believe quality franchises over the 3 to 5 year times from here, in many cases, we will see doubling, tripling, and quadrupling from the levels where we are seeing them today. Therefore, this is a real opportunity. There are positives as well, but I think we can talk about it in the ensuing discussion.
No, absolutely. Thanks a lot, Mr. Shah, and thanks for that positive note, which is probably much needed in markets today. That this is a real opportunity. We have a lot of questions from our viewers and the audience who are watching and hearing you speak. I'll quickly go over some of them. Some of them are, one question that has come to us is from Ajay Alsinghani from Mumbai. He wants to know, given the Nifty's performance in April and given the economic data that is coming out, are the markets being too optimistic? Are they pricing in a kind of a recovery that is probably going to be delayed much more and not going to happen quickly? Is it, are the markets setting ourselves up for a fall again? What has happened in April?
Well, as I said, three possibilities remain.
Right.
Prices fall and may torment us even more. Prices may stabilize, seeking a direction and giving the time to recover, or
Right.
prices rise. All three are possible. I can't comment on the sentimentality. Fear,
Right.
greed, arrogance, and envy will keep recurring. Today it is fear, and therefore prices have receded from values. Is the fear slowly, bit by bit over a period of time, fear subsumes into more balanced assessment,
Right.
maybe prices will gravitate more closer towards the value. It is equally possible that the fear may continue to engulf for a length of time, and therefore prices may even recede further from the value. That we cannot comment upon. What we can comment about is where we stand, and that's where it is an attractive opportunity. Whether it will get more attractive thereafter tomorrow, time will tell. We cannot comment about that.
Right. So, but given the Nifty's performance in April, do you think the fear factor has gone away to be replaced by some more optimism?
Well, April clearly has shown positivity, but
Right.
I would not read anything much into that.
Right.
Prices are no guarantee that prices can't fall any further or that the prices have to rise. Equally, as expensive prices don't mean that prices will start falling automatically from tomorrow or that they
Right.
can't rise anymore. These things we should not try to make short-term, near-term judgments. I think I have to remain firmly afoot on the longer-term picture. We
Right.
have to make near-term assessments and invest reconciled with the present reality. The stress about reconciling the present emerging reality with the assessment of the future, because the two could be different, and living with it and fine-tuning it is actually the art and science of investing. So there is no getting away from that. I would say we have to remain watchful, we have to remain careful, we have to keep assessing every new data, every new insight that comes our way. We have to remain agile. But I would say it will be rational to be fearful. It is legitimate to have reasonable level of fear so that that caution brings sobriety in the way we do things. But it will be rather unintelligent to be paralyzed by fear and do rash things and throw things away.
No, no, absolutely, absolutely. So, Mr. B. Vasudeva Rao from Guntur, Andhra Pradesh, he wants to know whether it is the right time to invest in equities. What advice would you have for him, sir?
If you have a 3 to 5 year view and you have a capital to spare, which is over that period of time, and that you have a mind of still, you have a peaceful, calm mind, which can accept a possibility that prices may still further torment you going ahead in a way which you may not appreciate and may not like, and
Right.
yet you live with that stress over a long enough period, then I would say, and if you can select well, because you have to choose good businesses and not ordinary ones. You have to buy into terrific managements, not the compromise ones. You have to be with the balance sheets which can weather any possible further challenges rather than which can waffle away or melt away in these. And you have the capability to make good judgments about the underlying value of these businesses. If you can do all of that and you have that longer term mind, in my opinion, this is a fantastic time. But if any one of these is missing, then I think it is an exercise which can be in the self-defeat.
No, no, absolutely, absolutely. So, what you are saying also brings to mind one debate that has been going on all the time between value investing and growth investing. You think this is a great time for value investors, sir? Because that is a question that has come to us from Mr. Mangesh Barge of Pune. He says that value investing versus growth investing, which is better? And what would you advise at this time?
Well, I would say there is that artificiality which has developed in the investment literature, We talk about growth and value as if these are two different things. They are not.
Right.
Any value has to have an element of growth, and that growth has to be valued, and the price has to be cheaper than that value for it to
Right.
be a. And the pure cheapness without any underlying long-term growth is a bit of a cigar butt, and is
Yeah.
not really attractive investment proposition. For any investment to have a real value, it will have to have a growth, its compounding, its longevity, its solidity, and its strong quality. These are
Right.
essential ingredients into a value or an intrinsic worth, and the discount of that value or the price which is cheaper than the value is a real definition of the value that you buy into. Therefore, both growth and the value have to be integral part of the investing. It is not a choice of one or the other. If you
Right.
can't see of them together, then you have to. These are not cigar butts of Grahamian style. That was an era of the Great Depression where palpable cheapness was so much there that you didn't have to seek any growth. I mean, cheapness itself was so much that
Right.
just buying into that cheapness was a reward. But that can't be normal ways of investing. Therefore, the two things have to dovetail into each other. Coalescing of the two only can be a foundation of good investing.
That's right. Absolutely, sir. What are the sectors you think that one should watch out for and should invest in for 2020, 2021? There is also, this question is from Mr. Arul in Mumbai, and there is also a question from Mr. Rakshit Mahajan from Jalandhar, who wants to know what is the future of companies like PVR and Interglobe, Indigo Airlines for that matter. That is one, this is a question that a lot of people have been asking. Aviation companies and leisure and entertainment companies, how are they going to fare in the next, say, 6 months to a year when there is still going to be a fair bit of fear and fair bit of uncertainty?
Well, let me answer in 3 or 4 parts.
Sure.
One, I'll not comment on any individual company in a public forum. That will be inappropriate on my part. But broadly, I'll say what appears palpably sharp and pungent today may or may not be the case over a longer term on a more sober. Certainly, some part of the reality will indeed undergo change. As I referred to earlier, these COVID thing, whether we like or not, at least for some length of time till credible medicines or deterrent in form of a vaccine or both emerge, it will remain around, lurk around, and we'll have to deal with that enemy. Therefore, the way we live, the way we socialize, the way we work, all these in some form, some shape will be altered. Whether these are permanent and really adverse changes as far as some of the businesses that you named, time will tell. I'll say in a more philosophical stance, 3 or 4 things. One, typically tendency when faced with sudden events is to hunt for blue skies and try to run away from skies which look like overcast one. But what we think of overcast skies may actually be yielding their ground slowly towards becoming actually blue skies. But in our haste and in our unholy kind of a zeal, sometimes we make this kind of mistakes. Also, what we think are blue skies today may actually be getting into the overclouded or overcast zone. By the time you make the journey, they may actually have become overcast. Therefore, we have to make these judgments very carefully in a sobriety-based assessment and in a long-term thinking. Secondly, portfolio diversity, portfolio discipline, and risk control are very important ideas. Returns are nothing if they are earned without any sensible measurement of risk control. Therefore, when you surrender philosophy, when you surrender the key important attribute of portfolio diversity, and when you dilute the discipline and jump around in a sudden jerky way into one or the other, based on what may look fashionable or what may look attractive at a point of time, you may make mistakes. Thirdly, this is not to say that you don't critically assess what you have and what you you don't have. Of course, you need to do that all the time. You all the time critically assess what you have and what you don't have so that you know what you need to do going forward. Therefore, that exercise remains. But if your that analysis suggests that what you have is healthy and sensible and it has been well-formed and nothing terrible on a permanent basis and disproportionate basis has occurred, then trying to jump around may actually turn out to be more risky than what you may have imagined. Therefore, these things we'll have to deal with carefully. We'll find there are many businesses which actually will gain. Businesses in pharmaceutical, healthcare, diagnostic chain, it's very easy to see why they will gain. Even there is a short-term physical disruption. Equally, insurance businesses, where the health insurance, life insurance, general insurance, these ideas will be revisited in different way, and there are favorable tailwinds. In chemicals area, where India is a great leader, and in many areas, India is actually decades ahead of China, especially in pharmaceuticals, the quality, technology, superior pharmaceuticals. India is ahead of China by decades, actually. There are three areas where there is a significant opportunity: active pharmaceutical ingredients, specialty chemicals, and active agrochem ingredients. And I think some amount of weaving away of the supply chains from China began from 2017 itself in favor of India. I think COVID will accelerate that further. These are some of the sectors which will gain. But I'll not for a moment suggest just buy a theme and run around and do these. We have to make sober, overall balanced judgment, and true diversity and genuine diversity of the portfolio has to be ensured.
No, absolutely, sir. I mean, you're a real sober voice in these tough, difficult times. Mr. Chirayu Gupta wants to know about whether it's more profitable today to invest in ETFs or should you go for actively managed funds? What would you suggest?
Well, global markets in the developed world suggest that a very, very large percentage of the active managers do not over meaningful periods of time outperform the indices. Therefore, a large percentage of evidence is cast against active managers. In a way, I'm kind of self-flagellating myself because I'm an active manager in this activity. But therefore, there is a credible, strong evidence that large percentage of managers probably do not have skills and temperament and real strength over long enough period to be able to do a credible job, both absolute return being reasonable and positive and relatively superior performance over a period of time. Both are important ingredients of any good active management. If you can't judge that and achieve that, then I think that active management is no money, no value. It is merely creating beta without creating any alpha. Therefore, just choose to throw a dart. Chances are 85-90% of time you'll be right by choosing an ETF. Maybe 10 to 15% managers only will be able to do that credible job of controlling beta and getting actually an alpha. But if you can choose managers and if you are able to build an analysis and understanding that why those managers will be able to do that and your confidence in their capability and their philosophy and ability, then I think those ones will produce returns. India is a market, I think, over still a few more decades affords that opportunity in the hands of skillful, balanced, risk control oriented, sensible, long-term oriented manager who can pick and choose from a bottom-up stock picking perspective.
Right, absolutely. Mr. Rajiv Saluja wants to know, it's a bit of a crystal gazing here. He wants to know when the Nifty will go back to the 12,430, 12,500 odd levels. And he says that it took 5 years after 2008 for the Nifty to really go back and hit the all-time high again. Do you think, when do you think, I mean, it's a bit of a difficult question I know to answer now, but when do you think you can see some movements of the Nifty towards that level?
Even omnipotent God doesn't know about it. I'm a mere mortal.
Yeah, no, absolutely. It's a bit of a tough question to answer at this stage. And Mr. Prakash Sharma from Guwahati has a very interesting question. He says, when liquidity is so abundant now, how does one actually judge the real worth of a company? How does one really value a company now? Because everything is now being driven by liquidity. And you look at what's happening in the US markets; it's all liquidity driven. Something similar is also happening in India, isn't it? So, what would you advise investors to do?
No, I think that is an incorrect statement for a person to make.
Right.
Liquidity in a near term may distort price. It doesn't change
Right.
the value. Value is what it is. Value is nothing but, in simple terms, present value of a business is nothing but sum total of the future annual real profits or cash flows
Right.
discounted appropriate time value of money rate, and sum total of these yearly profits in the future today, discounted those profits, is really a measurement of value. Now, whatever changes those cash flows, either the growth, the amplitude, the pattern, the quality of the growth in terms of capital efficiency, period for which these cash flows will be available, these are the elements that go into the value computation. If these any element keeps changing time to time, so will
Right.
be the value. But the method of value per se remains these only.
Absolutely. Absolutely.
Price near term may be disturbed, may get punch drunk in an ebullient way, or may get manic depressive the way it has been for some length of time recently.
Right.
So that is behavior of the price. The value is more sober, more judgmental, more measured. That doesn't alter that dramatically. And therefore, liquidity and confusing about mismatch of the value is an incorrect statement to make.
No, no, absolutely, absolutely. One more question on mutual funds, sir. Mr. Nilesh Bam wants to know whether one should go for equity or one should go for balanced funds now.
Well,
What would be your
uh, I fundamentally believe, this is my personal opinion,
Sure.
balance fund is a confused idea. It is an intellectual confusion. Because it's some percentage of equity and some percentage of fixed income, and
Mhm.
which can dynamically rotate based on the decision of the person who is managing that money. Instead, I would say that decision should be taken by the investor who is putting money, that how
Mhm.
much of his wealth he is going to allocate to equity, and how much he thinks it is sensible and reasonable to have it into fixed income as a part of overall asset allocation plan. To try to let it be swung by a manager is I think it is basically a timing decision, and timing decision is 325 years of recorded history of investing shows is a mug's game. Even in the hands of the most skillful investor, when he attempts to do the timing,
Right.
the egg will fall on the face. If not today, tomorrow. If not tomorrow, then day after, and with the severity. Therefore, that balance fund is a very confused idea, honestly speaking, as a product. One should decide how much money you want to allocate to equity, how much to fixed income, find suitable investments. If you can find yourselves, then do that. If you can't do it, find good manager who can do both of these, and put money as per that asset allocation rather than leave that judgment to the manager concerned.
Right. Absolutely. Thank you very much, sir. Two final questions. One point I wanted to ask you is regarding mid-cap funds and small-cap funds. They've been beaten very badly. They've been battered in the last 2.5 to 3 years, and a lot of money is still chasing the large cap stocks. Do you think it is the right time to put money in mid-cap and small-cap funds? There is a lot of value. You also talked about it. What would be your advice?
3 points. One, our preference has to be selecting and choosing underlying attributes which create value rather than the title of a mid cap and a small cap and a large cap. It
Right.
is underlying attributes which create value, It is not some artificial description of what is a small cap or a large cap or a mid cap, which is going to do the trick. And the attributes remain simple, time tested over centuries, quality management, quality business, which is large size of opportunity, therefore ability to create a compounding kind of predictable long-term quality growth. You as an investor, you have an ability to judge the value, have discipline to buy margin of safety, and then the wisdom to remain with this position, assess it, but remain so long as that equation favorable to you. And that's what investing is all about. You will find these attributes in small cap companies also, some mid cap also, and some large ones also. Some small ones become mid-sized ones over a period of time, and then they gravitated to become the large ones. Some mid ones they become large ones as well, and some large ones they become super large ones as well. But equally true is reverse. It is not that fashion or the trend, now mid cap, now large cap, now small cap. These are actually very frivolous and very unintelligent aspects that people get carried away in terms of the investing. You have to choose a business as a bottom-up business. If it happens to those virtues are in a small one, then you buy that. If they are in the large ones, you buy into that. And the idea is to ensure that what is not so large will become large over a period of time. But it is those attributes which will make them large or otherwise. It's not some benediction from God above which is going to create a magic that small automatically become mid or large or otherwise.
Absolutely, absolutely. Thank you very much, sir. Thank you, Mr. Bharat Shah. Thanks a lot for joining us. It's great to have you here and your insights into investing and what is value and other issues. Thank you, sir. And
take care.
Take care. Thank you.